All right, what's up, YouTube? Hope everybody's doing well today. I'm coming at you dressed classy to give you 3 reasons why I think the bear market is at or near its lows, its bottoms. So let's get straight into the charts. I'm going to keep this quick. All right, so you've probably seen this over on my live streams, hopefully, over at twitch.tv/cryptojacks, all spelled with letters, no numbers this time. Shout out to Twitch for hooking me up with the name change. But in case you haven't been able to make it, if you're kind of the YouTube only audience, let me give you the visual for why I think we have 3 strong reasons to believe we're either at or near the bear market lows. Number one, the regression curve. The regression curve has been a really good sell and buy indicator through the years. This goes back almost an entire decade. In fact, if I show even this old price history, you see how it played out. Now, bring that to present. We are right at the regression curve. Okay. Now, yes, a fair criticism to this is that, well, you know what, we didn't hit the highs, so are the lows worth anything? And I would argue that yes, that through the history of Bitcoin's price action, that the price has spent more time consolidating along the lows than any of these top touches. You're talking about a day here or there, over the last 10 years versus entire weeks and months of grinding along. So yes, I think it's a very strong reason to suspect we're either at or near the lows. You can see we've kind of wicked down through it on the BLX. Now, that is point number one. Point number two is my pivots. I personally love pivots. Back when we were talking about selling close to 60K, I think it was 59 when I got real vocal about it. My immediate buy level was down here at the S1 pivot. This is the first level of support on the yearly pivots. If pivots are something you're interested in, here are my setup. Here's all the way it's set up on Woody, yearly, and 15. And if you go into indicators, pivot point standard, this is a good one to use. So now you have, the indicator for yourself and then the settings. So hopefully you can pull that up, you monitor it, whatever. The reason I like the S1 pivot with respect to a bear market bottom is if we go 2 cycles ago, this correlated very closely to a bear market low. We look at last cycle and we see that the price broke below it and closed below it and then consolidated. But this little reversal, which was a ascending triangle, ascending meaning there was higher lows with equal highs. This ascending triangle was actually formed with the help of this S1 pivot. So this is where the market tried to roll over. This is where the shorts piled on. This is where everyone was selling, and then they had to buy back and close their shorts, which led to that little short-term rally. It was about 250% roughly in about 3 months, something like that. So it was a crazy little pop there. So I think it'd be very interesting to see something similar, but that's beside the point. So point number two in summary is the S1 pivot. The fact that we came down to it, we have not spent much time at it. We haven't consolidated. We didn't even break below it, right? Like we did last cycle. So we're behaving a lot more like the cycle before where we came down, we touched it. This is about a $10 or $20 difference. And we are above it. Now, the third point, which is equally strong as the pivots, in my opinion, is the 200-week exponential moving average. If we go back and we look 2 cycles ago, this helped to form the support, which rolled the price over to the upside. So the momentum was down. It broke like a water on the shoreline, water on rock. It sat there, consolidated. This was almost a year of consolidation, and then broke to the upside. Let's look back at that was 2 cycles ago. Here's last cycle. Again, we consolidated below it. We closed our very first candle below it just immediately, and then consolidated for a series of months, and then later retested it with the COVID dip, which was a kind of a freak of nature accident thing. And then here we are again. So price is above not only the 200-week exponential moving average, not only above the S1 pivot, not only above the regression curve, but it's also doing a couple other things that are very interesting. So those are my 3 key reasons that I wanted to just immediately get you guys to understand and to see like I see. But there's 2 other things that make a lot of sense, and it's more like support for the belief that I don't think we're going to go much lower. Like there's a lot of conversation about sub 20K, maybe 10K, that kind of stuff, because that's where quote support was. But I want to make a quick point with respect to 20K. 20K was the last cycle peak during the last cycle. The cycle, it was, defined as this 2016 to 2020. This was a halving. This was the next halving. So everything that happened between the halvings. So what you'll notice is that from one halving to the next, the bear markets have never come back and actually tested the prior all-time high. So to believe that the price is suddenly going to break our 3 key supports that we just went over and come down and do a first ever that we're going to come down, we're going to touch or break the last cycle all-time high, it seems kind of a stretch. So you're betting on a lot of things to be a first-time event. You know, the first time we go below all those 3 things that I went over before, the first time to come down and touch, and even touch 20K, the first time to break below 20K. So you're the people betting on that are betting on the low odds chance, in my opinion. It's like I talk about on my live streams. I liken it to sports betting. Yeah, I mean, when you're betting on LeBron James, are you going to bet that he's going to have a pretty good game? Or are you going to bet that he breaks his ankle in the first quarter? Like, they're both possible. Neither of them is impossible. But what is more likely, right? So we're stacking up evidence to kind of build the what is more likely scenario. And to me, that's kind of screaming that this 25-ish range, this level, is probably the low or at or near the low. And then the second is if we go back and we look at when traditionally the bear market bottoms take place, and if we measure it with respect to the last halving, you know, we go over this as well on our live streams, you notice that the last 2 bear market lows took place at about 800 and 880 days. So if we look at that range, that 800 to 880 day range, well, that's here. And then it extends out another, you know, couple months. So call it that little window of time right there. So this is basically based on what we have seen historically. This is the typical bottom, like the bottom is printed somewhere in this range. So we're talking about finding out for sure in the next 4 to 5 months, kind of what's going on. But after that, in my opinion, all bets are off. So I think the fact that we're so close to when historically the markets have bottomed, the fact that we're above my 3 key levels of support, and the fact that we've never come back and actually tested a prior cycle's all-time high, I think that these are really good things to keep in mind when trying to determine where a bottom potentially is. Okay, that's it for this video. Thank you for watching. As always, we'd love to see you over at the live streams. We do it a few times a week. Lately, through the summer months and the kind of during the bear market, it's been kind of tricky. Twitch.tv/CryptoJack is my URL, and we'll see you next time. Thanks. I'm not trying to be perma bulljack, perma bearjack, just charts jack. Just whatever the charts are telling you, that is all I'm good for. That's all I'm here for, and nothing else. I'm not your hype man. You know, I'm not your bear guy telling you to sell.